Hi there. Welcome to Trading with Rich in the Philippines. The main aim of this channel is to help expats who are planning to move to the Philippines or any other SE Asian country. My lovely Filipina wife and I will be documenting our day-to-day life in the Philippines, sharing our monthly budget and expenses. This will give you a realistic idea of what it's like to live here, and help you make an informed decision about moving here. While we cover several topics, finances are my main emphasis. In this video, I'll show you how to calculate call and put credit spreads on ROI, which will help you evaluate the risks involved in stock options. You can also use these calculations to review covered calls. Thank you for tuning in, and we hope you find our channel helpful. If you're looking to supplement your income, trading stock options could be a good part-time job. Instead of letting your medical emergency fund sit in a bank account overseas, you can invest it in the US stock market to earn a better return on investment. Many expats in the Philippines take out PhilHealth insurance for about $370 a year and put aside some money for a medical emergency fund. With this fund, you can invest in the stock market. $10,000, $25,000, whatever your insurance fund is. Mine is $25,000 because I have a heart condition. Earn 8 to 10% a year instead of watching it grow at less than 1% in savings. By renting out your stocks with covered calls or trying your hand at cash secured puts, also called put credit spreads or calendar spreads, you can make it grow 2 to 4% a month, which is 20 to 30% a year. However, it's important to note that trading a stock option is not a quick way to make cash. This is not a get-rich-quick cash-making machine. Being a successful professional trader requires understanding how the premiums are calculated and making informed decisions on those trades. You need to know how to use the time value, expiration dates, volatility, and company trends to execute trades that have a high probability of profit. Buying and selling calls and puts is technically very simple, and there are 4 basic ways to trade that form the basics of options trading. You can buy or sell a call, and buy and sell a put. Sending money to the Philippines is very easy and doesn't cost much. I show you how to transfer $2,999 from Capital One to Philippine National Bank for $25 on my channel with a video transferring money to the Philippines. So, if you've set up your brokerage account, let me show you how to make $300 a month or more, using stock options from anywhere in the world. It's not rocket science and it should take you less than 4 hours a week. Most of your time is spent on research and doing your due diligence before you invest your hard-earned money. Here is an example of a put credit spread, also called a cash secured put, or a bull put spread. Amazon sell a $165 put buy a $160 put, insurance policy, 27 days to expiration. Premium, margin requirement, hash of days to expiration /365, equals return on investment, ROI. Amazon AMZN calculated. Premium $67, margin requirement $435.27 multiplied by 365 days /27 days equals 14.8% x 13.5 equals 200% annualized. Margin requirement example. Contract spread x $100, multiplied by the hash of contracts minus the premium you received. AMZN, 5 spread between $160 and $165 by 1 contract equals $500 margin, then subtract the premium of $64.73. Margin requirement $435.27. If the stock should go below $160 you stand to lose $435.27. Over $165 you gain $64.73. $500 to 64.73 equals 435.27 margin requirement. A 14.8% return on investment for those 4 weeks of the contract. Annual return could be 200% if you won 13 times. 4-week contract done 13 times in a year. Don't count on that, winning over 70% of similar contracts when your ROI is 30% is break even. Don't leave me yet. Hear me out. The ratio of losses to wins is important. Winners keep score. I didn't come to sit on the 50-yard line, I came to play. Here are the game rules. You must pick a premium with volatility that you can be comfortable with. The credit spread will always escrow a margin requirement, $100 for each contract with a $1 spread between the strike prices. You get to remove the premium from the margin requirement. Key point. Lower ROIs will require higher loss ratios. 25% ROI with a 1 to 3 loss ratio equals 1 loss and 3 wins with a 25% ROI will break even. 20% ROI with a 1 to 4 loss ratio equals 1 loss to 4 wins with a 20% ROI will break even. 16.6% ROI will need a 1 to 5 loss ratio to break even. My rule of thumb or parameter when doing credit spreads is a 1 to 3 loss ratio and 25% ROI to make it worth spending the fees and making it worth my while. Any ROI over 25% is gravy and profitable. $25 earned with a $75 potential loss is in my comfort zone. This is not a perfect science, but it works for me. This Amazon put credit spread returned 14.8% ROI over 4 weeks. I know this can get complicated. You're probably saying, Rich, where are you going with this? You must understand how much do you stand to lose with the gain that you're trying to earn. I'll use this Amazon example to explain the formula again. I got the 1 to 7 ratio by taking my premium and dividing it by the margin requirement. 64.73 435.37 equals 1 to 7 1 loss for every 7 wins. Did you earn enough to make it worth your while to invest the margin requirement? If the stock should go below $160, you stand to lose $435.27. If on the expiration date it's over $165, you gain $64.73. ROI 14.8% over 4 weeks, loss ratio was 1 to 7. $64.73 gained with a potential loss of $435.27. If you win over 70% of the time, you will stay above the break-even. This example assumes that you executed 8 similar contracts. My rule of thumb is to look for 1 to 3 ratios while keeping at least an 80% out of the money, OTM, strike price that returns at least 25% return on investment, ROI. Premium of $25 earned 3 times equals $75. $75 earned will offset the margin requirement of $75. Margin calculation, $100, $1 spread x 100 shares of stock, dash $25 premium equals $75. If I need more help to get my ratio lower, then I will extend my expiration date to get a higher dollar premium. The ROI percent will be lower, but the margin requirement will be considerably less because I earned a higher dollar amount on the premium. This is not for the faint of heart. Know your risk tolerance levels. Most important, know your company. Stock must have good volatility, with an expiration date and out-of-the-money strike price that allows for 70% or better win rates. Pick a stock with good volatility for a good premium. Choose an expiration date that helps ROI. 3. 70% win rate on a 1 to 3 loss ratio. 80% out-of-the-money strike prices is comfortable risk for me. High pop, percentage of profit, can be wiped out with one train wreck. Pigs get fed, and hogs get slaughtered. Exit strategies are very important. Buying a short call, insurance, on a put decreases the total cost, but limits gain potential. It does drop your margin requirement substantially. You have made this a measurable risk by adding the insurance, buying the short call and limiting your loss at that strike price. It is no longer an unlimited risk, and you have reduced your premium because you reduced the risk. Very smart play. The margin requirement is a lot less. Much better overall ROI. This lesson has taught you how to calculate your return on investment, ROI, on call credit spreads and put credit spreads. These calculations will work with other option plays. Iron condors, straddles, covered calls, etc. All are calculated by these formulas. Remember, there is always someone else on the other side of the desk. Someone must lose in every stock option trade. There is no bank here. The broker is the middleman, making sure everyone plays fair. Risk management, the most important part of trading options. Knowing how much is at risk against your potential gain is the key to good stock option trading. You are arming yourself with all the available data to make an informed decision. This is still a gamble, but the field is leveled a little, if you know all the rules and play within a game plan. Winners keep score. Calculate your ratios. Know the OTM and the ITM percentages. Look at different expiration dates and see how they affect your return on investment percentages. Do not get caught up in the dollars, stick with the percentages. Do not get caught in the FOMO moment. Fear of missing out. Do not try to catch the falling knife. You don't know where the bottom is or how high a stock may go. If a stock went up too fast or down too fast and you missed out, accept that as part of the game. It will most likely do a correction either way. We've all seen the Bollinger charts. They are not a straight line. Human beings are basically very positive about stocks because the market has averaged 10% over the past 50 years. In any given year, the market is not up exactly 10%. On the contrary, it is a violent swing. Down 6% one year and then up 23% the next year. Numbers do not lie. Percentages can be misleading when looking at your final return. Example, stock ABC cost $100 2 years ago. It lost 50% of its value in year 1, making it worth $50 a share. Then in year 2, ABC went up 50%, making it worth $75 a share. You don't recover all of your money with percentages. You are still down $25. Reality check, we are still down half the dollars from 2 years ago. Always calculate the money in the bank by the dollars, not the percentages. Percentages are there to help you with your parameters to make good decisions. The market is a daily roller coaster. The stock market does not go up evenly and steadily every day. They say, you need to risk money to make money, but they also say a fool and his money are soon parted. I hope this lesson on calculating ROI, return on investment, was helpful. I'd love to help anyone trying to earn an extra buck, living overseas supplementing their social security or pensions. Drop me a line at tradingwithrich@yahoo.com. I would love to hear from you. Rich Dicky.